Evening, guys. So as we were talking about support and resistance yesterday, and I told you how the market uses the bottom row as support and uses the upper side as resistance. That if the market, if you view the market this way, if you see it like as if, let's say you're in a room, and if you throw a tennis ball on the ground, it will find support, and if it hits the ceiling, it will find resistance. It will resist to go higher than that and come back and bounce, and so on and so on and so on. And I told you this is support, and then this is your resistance. So now one thing I want to show you is I'm going to repeat what I said yesterday about this, that this area here is your first, that's what's gonna give you a trade. The reason why you're gonna trade this is because you found out how this floor or whatever goes. It's not straight, it's not level. If it's like this, the reason you know it's like this is because the market went up, came back down exactly here, and then went up again, and then now that you have this and this, you can now predict that the market is gonna come somewhere here and then bounce and then keep going higher, and so on and so on. You understand? You can predict every time where it's gonna turn, because if you had a wooden floor pressed like this, or a ground that goes like this, if something kept bouncing, you'd predict when it's gonna bounce and go back up. So this gives us resistance. So now I'm gonna use this, I'm gonna use a chart to prove the same example. You know, as you can see here, let me screenshot this to make everything simpler. Okay, so now what's gonna happen is, as you can see, the market went up, came back and bounced here, then the market went up, and then now the market came here. And as you can see, if you draw a trend line from here going straight this way, look at what happened after this second time. The market bounced and went higher, and then came back, and you could predict where it's gonna bounce. Why? Because this was a second response, and everything after that, it's gonna find support. It's like having a ground. It gives you a reason to enter every time the market comes around that place. You understand? Every time the market comes around this place after the second time, without this we don't know anything. But now when this candlestick does this, that's your entry. When it comes back against that trend line, that's your entry. So every time it does that, you're gonna find entry. And this, let's say this is our roof right here. You know, let's say the market uses this as a resistance. It failed to break, and it failed to break. So now what you see is the market went up, came down, went up, came down, and now you can almost predict if it comes back here, we're gonna have to sell, and then so on and so on. It's playing in between these lines. You understand? It's just like real life, guys. Like if you're struggling with this, you can ask me for help, but it's very simple. Let me find this, let me use this. Let me try the weekly. Okay, let me use my template, the daily. As you can see here, this is what used to happen, and I predicted this a long time ago. It used to be like this. Or you could draw it like this. Yeah, it's like this. So now every time the market found this support it bounced back up. Sorry about this. Let me fix it. Every time the market found this support, it bounced up after this. This was the second response. So now you knew if the market came back. I have a picture that I did of this, that I predicted that this market will come all the way down here, which is on a daily chart, that this market will come down here. After that, it's gonna go up, and then it's gonna come back down. I did this, I think, over a year ago. So I predicted that the market would do exactly this, and how did I know? It's because of this second response. And with pips, the reason why I don't trade small time frames is these are time frames. If I go to the 1 minute time frame, that means every candlestick is 1 minute. 5 minutes, every candlestick takes 5 minutes to complete. So if I'm on the daily time frame, that means every candlestick takes a day to complete. So if I'm trading this, if I buy here and I say the market is going to come all the way up there, that means as you can see, there's 32, 6,355 and 0.81 blah blah blah, so on and so on. The first number, that's the number of candlesticks. It's not days, or if you're on a daily time frame, that means that's the number of days. And the others is pips. That means if you place a $1 trade here, that means when the market gets there, you made $6,000, which is about 80,000 in rands. So and the rest, that's current price of the market. That's the price when the market was there. So yeah, if you traded this against the trend line, you'd have a very small stop loss. You understand? Your stop loss would be something like 200 pips, which would be here. If the market goes against that trend line for this long, you're wrong. That's 200 pips. And you're risking this much money, you're risking this much to make this much. You understand? You're risking 200 pips to make 6,000 pips, which gives you a great advantage. And now if we look here, let's go to the weekly time frame. If you look here, the market came back to retest that trend line. You can see on the daily it came back to retest, and now it's gonna start dropping and going against that trend line, and it's gonna go lower. Why? Because now previous support turns into resistance, and it's gonna go lower in the future. You understand? So yeah, if you have any questions, feel free to ask me, guys.